JPMorgan has their price target set for Tesla stock at $90. 90. Let's talk about it. Welcome back to my latest episode calling out mainstream analysts and their bull. A lot of people seem to think that JPMorgan is a reputable name since they're such a huge investment bank. But don't get it twisted. These guys are biased morons. The analyst who set this $90 price target for Tesla stock is ranking in the bottom 10% of analysts over on TipRanks, and honestly, I don't think he should have his job anymore. So today we're going to be running through Ryan Brinkman's analysis of Tesla stock to see why in the world he thinks that they're going to fall by over 85%. Before we get into it though, if you enjoy this type of content where I call out mainstream analysts and their stupidity, make sure to like this video so know to keep making this content, and subscribe if you're new to the channel. With that out of the way, let's get right into his analysis. The analyst who gave this rating to Tesla stock, Ryan Brinkman from JPMorgan, set his $90 price target for Tesla stock on December 9th when Tesla was trading at $604. Now, I'd understand Ryan Brinkman's analysis maybe if he set his price target back during the Rona stock market crash when Tesla was trading between around $70 to $160. But right now, it makes absolutely no sense. Ryan Brinkman really thinks that Tesla stock is going to drop from a price of around $610 right now to $90. Maybe if they do another stock split, he'd be right. To commend Ryan a little bit, he did raise his price target by a whopping $10 from his last rating from $80 to around $90. His last sell rating for Tesla stock came on October 22nd when he set a price target of $80. This was when they were trading at $425. And if you followed all of his past ratings, 33% of them have been successful, and they've had an average return of negative 95%. So if you want to turn $1,000 into $50 instead of the other way around, follow Ryan Brinkman's advice. But that's enough bagging on the dude for now. Let's see why he thinks investors should sell Tesla stock, because maybe he has some good ideas. According to Seeking Alpha, this JPMorgan analyst gave credit to investors that snapped up shares of Tesla ahead of the S&P inclusion news. Now thanks, Ryan. I really needed that validation from you. Except I didn't, because I knew that it was just a matter of time until Tesla was included into the S&P 500. It wasn't a matter of if, it was a matter of when. I was calling this way back in September when Tesla stock kept falling and kept falling and kept falling, and I kept buying, and kept buying. And if you want to know the next time I buy Tesla stock, I post all the trades that I make over my Discord, which is going to be linked in the pinned comment below. But anyway, getting back into the article, Ryan Brinkman seems to disagree. While Ryan commends us for buying ahead of the S&P inclusion news, he recommends that investors hold back from raising their positions off of the S&P development. Now, I'm not sure if this analyst thinks that S&P inclusion is going to be a buy the rumor and sell the news type of event. Because if he does, well, Ryan, obviously you don't have an understanding of fundamentals. If you took an econ class back in high school or even college, you would have seen this graph. Now, this is the supply and demand graph. And whenever there's more demand than there is supply for any commodity, in this case Tesla stock, the price is going to go up. Right now, there is a healthy supply of Tesla stock at around 760 million shares in the public float, which means that almost 800 million shares of Tesla stock are available to trade in the public market. But soon, that's going to change. You see, the S&P 500 is an index that's weighted by market cap, which means that the S&P 500 and their index trackers like SPY are going to have to buy a specific amount of Tesla stock according to the overall value of the index. MarketWatch estimates that Tesla will make up around 1.5 to 1.6% of the S&P 500. And to add to this, there are $5.3 trillion, yes, I said trillion, that are allocated to funds following the S&P 500. So if we do just a little bit of quick math here, this means that the S&P committee and their index followers are going to have to buy $79 billion worth of Tesla stock. And at a current value of $610, this amounts to 130 million shares of Tesla. Now, if you didn't know, the S&P committee decided to add Tesla stock all in on one day, which is going to be on December 21st. Monday. This means that these S&P benchmarks are going to have to buy 130 million shares of Tesla all in one day. In a perfect case scenario where nobody sells Tesla stock, which is very unlikely, this would bring the public float down from 760 million shares available to the public market all the way down to 630. which would represent a decrease in the public shares available by 17%. But my speculation is that about half of the shareholders for Tesla stock will be selling come December 21st. This would represent about a 9% decrease in the public float. With 9% less shares available to the public, along with increasing demand for the upcoming fourth quarter sales report, this is going to end up creating a massive upside for Tesla stock. Now maybe, just maybe, Q4 sales will be a buy the rumor and sell the news type of event, but not S&P inclusion. The next argument that Ryan, the analyst, brings up is a classic, comparing Tesla to other automakers. He says that Tesla is trading at a 175 multiple of next 12-month Bloomberg consensus earnings per share versus best-in-class auto comps BMW, Daimler, and Toyota at 14x, 10x, and 16x respectively. Now, let's not forget that the consensus EPS over the past year has been wildly wrong. In the last year of quarterly reports, Wall Street has estimated a total loss of negative $1.88 earnings per share, when in reality, Tesla posted a $6.32 earnings per share for the entire year, which means that they ended up beating Wall Street consensus by over 4 times. And I've got a feeling that next year, Wall Street is going to have it even worse. For some reason, these analysts at investor banks seem to think that Tesla stock is simply a car company, but it's not. Right now, Tesla is selling their full self-driving software for $10,000 a piece, and this is subject to increase once the technology improves. And they might also be offering this as a subscription service. This means that Tesla owners might be paying monthly in order to have full self-driving on their cars for a piece of software that was written years ago. Now, of course, this isn't completely free money because they're still going to need software engineers to fix any possible bugs, but overall, software is a very profitable business. On top of that, full self-driving will also allow for Tesla to start their robotaxi network, which is basically going to eliminate other ride-sharing competition. Still think that Tesla is just a car company? Well, think again, because it's also going to become an insurance company. Elon Musk hinted towards this in Tesla's third quarter earnings, where he said that this could make up about 30 to 40% of Tesla's entire valuation. This would end up being such an easy cash grab for Tesla. All they'll have to do is offer it at the purchasing site of their vehicles, which would encourage more people to take part in it. And since their cars will be fully autonomous based on artificial intelligence software, this would mean that Teslas will get in less and less and less crashes, meaning that they're going to be taking all of this insurance premium from customers and rarely having to pay it back. Seriously. Name another company that's doing all of this. What other car company do you know that's going to have full self-driving, robotaxis, and their own insurance system all within the next year? I'll wait. Ryan Brinkman continued his argument, saying that Tesla is trading at a multiple of earnings higher than any nominal term for any company in any industry at any point in history. Again, he compared them to traditional automakers, where Tesla is trading at a price-to-sales ratio of 15x, BMW, Daimler, and Toyota are trading at 0.5x, 0.4x, and 0.9x accordingly. Honestly, you can't base a company's value off of fundamentals anymore. Whenever you have Nikola stock trading at a market cap of $7 billion with absolutely no earnings, these fundamentals have gone out of the window. And JPMorgan still recommends that you buy Nikola stock. That's just advertising dollars at work for you. Personally, I think that value should be based on the effect that a company has in the world. And honestly, I think that Tesla is having the biggest impact. It really wouldn't surprise me if at some point in the next few years, Tesla stock would become the biggest company in the world, surpassing tech giants such as Apple, Amazon, and Microsoft. We have Elon Musk out here doing the absolute most. Tesla has the best engineers in the world, and there's no stopping this force. The competition that Wall Street analysts continue to bring up time and time again are so far behind, and even when they get to where Tesla is right now, Tesla is already going to be millions of miles ahead. You can really think of this as a 1,600 meter race where Tesla is finishing their last lap. Meanwhile, the competition just got off the starting line. If Ryan Brinkman really thinks that the competition is coming for Tesla, well, he's going to be sadly disappointed. Anyway, that's all I've got for you today on JPMorgan's analysis of Tesla stock and their $90 price target and why that's complete bull. Thanks for tuning in, and as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.